Hi, and welcome to Your Prosperity, a podcast series on financial topics including tax, wealth creation, superannuation, lending, audit, and many other things that we deal with here on a regular basis at Prosperity Advisors. As with all financial podcasts, any advice you hear in this is general in nature and not to be relied upon. Please contact us for any specific advice. Hi, and welcome to the podcast. Today is the 23rd of August, 2023. I'm here with Gary Dean, who's one of our financial advisors, one of our experts here, one of the directors at Prosperity. We thought it was time to have a chat about insurances, personal insurances. We're not talking about insurances on your property or your car. We're talking about personal insurances where you're insuring the most valuable asset in your life, your life probably, which is your actual life. And there's a range of different, insurances, income protection, life, etc. So we're going to go through all of those. Gary's going to give us all the tips. We're going to talk about when you should look at to get in, when you should look at to get out, what's relevant for you, what's not relevant, and hopefully get a better understanding on insurances. So Gary, thanks and welcome to the podcast.
Yeah, thanks, Brendan. So I'll just kick off with the usual disclaimer. So,
of course, thank you.
Yeah, so today's discussion is general in nature, so it doesn't consider anyone's personal objectives or financial situation. So, let's get started.
Brilliant. All right, talk to me about personal insurance, Gary. What are the types of the four major types, I guess, of insurance? What are they? How do they work? What do they do?
Yeah, look, I guess the big one is life insurance. So really important, I guess, when you want to provide financial protection to dependents, so family members. So life insurance generally taken out to make sure that financial legacy is able to be passed through. It's upon death, it's paid out as a lump sum. And it can go through to beneficiaries to pay.
It's insurance my wife benefits from, not me.
That's correct. That's correct. The second one is total and permanent disablement insurance. So this is where you suffer a pretty serious illness or injury that basically stops you from going back to work in your own occupation in the future. So again, it pays out a lump sum, and it's there to pay off those really large expenses to help out your family going forward. The next one is income protection, and this is
one that I like because it's tax deductible. So good one.
Yeah, that certainly helps managing the costs. But income protection is really designed to cover the family's income needs in the event that you can't work today. So today's policies will generally cover around 70% of your current salary. And the really important thing with income protection is that you want to have a policy that's going to cover you for the long term. So there's policies out.
I was going to say, I like about this one, it's quite good to cover stupidity as well. So if I'm going skiing in Japan in January, which I think I am, and I wrap myself around a tree, it still pays out if I'm unable to do my work, even though I was the one who put myself around said tree.
That's correct. That's correct. And you really want to make sure it's long term, because you never know how long you're potentially out of the workforce. So there are policies out there that may only cover you for a year or two, but think about the fact if you're off work for 5-10 years, well, then you need a policy that's going to continue to cover those income needs for the family.
And a couple of things about that too, I guess it's often a lot of people will say, I've got that in my super, which you may, but it's whether it's good enough and it should be in your super and that's the right policy for you. But also, if you're paying tax in your super at 15%, you're paying tax at 47% in your own name. I know where I'd rather claim the tax deduction on the policy, but that's I guess, general in nature advice and definitely not specific as well.
Yeah, that's right. And I guess a lot of people have retail or industry super funds where you may get some default income protection cover, but often that cover only has a benefit period of 2 years. And that's a really important detail. Often that's overlooked. And it's not until we sort of sit down with a client and realize, well, hang on a minute, that's not going to solve the objective of covering your income for the next 20 or 25 years.
So that cuts out after 2 years. And I guess importantly too, I see we're not seeing as many new clients with this issue, but definitely have seen some in the past where, I've heard yourself or Hamish or one of the other advisors talking to them about insurance, and all of a sudden it's, oh yeah, I've got a 30-day policy or a 20 or a 15-day policy. Some of them I saw one day or heard one day. And you pay a lot for that premium. And yes, it kicks in after 30 days, but do you really need to kick in after 30 days? Have you got enough to get you through for maybe 2 or maybe 3 months?
Yeah.
And if it was a 90-day wait, it's a hell of a lot cheaper than a 30-day wait. And maybe that's an option for you. And apologies if you're going to talk about this later, Gary, and I've jumped in early there.
No, that's all right. Well, it's important to look at a range of things there. So all income protection policies have a waiting period before you get the first payment. But you need to figure out, well, what's your cash flow position? How tight is your cash flow position? Do you have sick leave and holiday leave, long service leave that might get you through for a longer period of time? Because by increasing that waiting period before you get the first payment, it can make a big difference to the ongoing premium that you pay. So that's certainly something we have a look at with our clients over time to make sure they've got the right waiting period.
And I know there's also stepped and leveled. Those are the terms are they still the terms we use, or have they changed those terms?
No, they're still around. So yeah, there's a range of different ways that you can pay premiums. See, the level premiums, you basically pay a higher amount up front in the anticipation that the longer you hold the policy, the more benefit you'll have as the premiums sort of level out in the later years. Whereas stepped premiums, you pay a lower premium up front, but they tend to go up more with age as you get older and inflation. So premiums are always something that need to be managed in accordance with to make sure that you're getting value for the insurance cover.
Yeah, absolutely. And that's one that I guess can be more expensive later in life. And I think we might circle back and touch on that. But what was the fourth type of cover? I think we only got through three and I sidetracked you.
Yeah. No, the fourth one is trauma insurance. So trauma insurance is a bit different. It's got nothing to do with whether you can work or not. It's purely whether you're diagnosed with one of the conditions that are listed on the trauma policy. So policies today will often highlight 30 or 40 different conditions. Probably the three big ones are cancer, heart attack, and stroke. They're probably the most common claims on trauma, but there are a whole range of other factors that are covered on the policy, and you get paid a lump sum amount. So it's purely diagnosis, medical sign off by the doctor, and you receive a lump sum payout from the insurance.
And that's a pretty quick payout too, isn't it? That one that you can get.
Yeah, look, they're usually sort of the claims process is a bit quicker on insurance because it's black and white, mostly whether a claim's valid. Whereas something like total and permanent disablement, it can take an insurer maybe a year or two to come to a decision or conclusion as to whether someone will actually claim.
But traumas are very cut and dry. This is one of the conditions. You got lung cancer, you get money. And I guess the benefit of that, as I've always heard it explained to me, is that you have a pretty significant life-changing event that's occurred. And sometimes it's great that obviously if you catch it and it's resolved straight away and it's cleared and it's no ongoing, but hey, you had the event, here's 200 grand, you can take some time off, you can think about it, and you don't have a financial stress to worry about, so you can make good decisions for you and your family in that time of need.
Yeah, trauma is all about giving you some choices. Like you may suffer a trauma event, but by the time your income protection policy kicks in, the insurer may say, well, you're okay to go back to work. You've recovered. So the trauma payout actually gives you the opportunity to take some time off work, so that you can get a full recovery or feel comfortable about going back.
And do what you need to do, I guess, as well. With those policies, very hard to obviously give an exact number, but life, TPD, income protection, trauma. Can I put you on the spot, Gary? And I should have given you a heads up on this, but I'm a 35-year-old GP. Let's go with that. Obviously, I'm a 46-year-old accountant, but let's go with a 35-year-old GP. I'm making 250 grand a year, 300 grand a year. What would the sort of I'm healthy, I'm fit, I don't smoke, I occasionally drink. Yeah. What's a bit of a guide, and obviously nothing to hold you to anything here, but just a bit of a guide so people know, is that something that costs $5,000 or $500 kind of thing?
Yeah, look, I guess a whole range of factors come into the premium calculation. So it comes down to gender, occupation, the amount of cover that you're applying for per month.
Yep.
So income protection can be quite expensive depending on on those factors. But
what
I
would you
always
put
say
in as a number? Give me a number, top of your head.
probably 2 to 3 grand as a guess based on that age. But you've got to always remember you do get the tax deduction on the income protection premium. So that certainly helps. You want to look at what's the real cost to me of covering this
Absolutely.
income. And the value you've got to look at is, well, if I claimed, how much potential income will I get paid out from the insurer over 10, 20 years? And often, if you're on a 6-figure salary, that number is going to be in the millions of dollars.
Yeah.
Time.
Oh, no,
So,
I agree. Just more to getting a guide for people out there, I guess, if they're hesitant, thinking, oh, that's too expensive for me and whatnot. And life's probably the other pretty common one, but that's much cheaper, obviously. Well, sorry, I'm aware it's much cheaper. What would a similar life policy cost?
Well, look, again, it comes down to the level of cover and what you're trying to cover.
I need $2 million to pay out my debts and keep things moving.
Yeah, you might be talking 1,500, $2,000 a year. But there are some options with life insurance. So instead of paying for it with your own cash flow, you might decide to hold that insurance through the superannuation environment. So therefore, you're paying the premiums with pre-tax dollars. And today you can either have a life insurance policy that's owned by your current super fund, or you can set up a separate life insurance policy where your super fund pays for the premiums each year via a rollover. So that actually gives you a lot of choice in the marketplace of selecting the insurance company you want to go with, but still effectively using your super money to pay for it.
Yeah. So if you're a professional, you're making good coin, you're 30 to 40, really, you should be coming and talking to someone like yourself about insurance to make sure that you're protected. And I guess I deal with it a fair bit every day. I guess I see it. I don't give the advice on that, but I sit in enough meetings where I hear you guys talking about it. What are some of the trigger points? So if you're, how would you when would you decide, you know what, we really need to talk about insurance with this client? What are some of the triggers that would make you want to talk to them about that, apart from just earning good money and wanting to protect themselves?
Yeah. Look, it's never too early to start talking about insurance because you never know what your financial position will be in the coming years. Like if you foresee that you're likely to have high levels of debt, and the earlier you get the cover, the better, because at least then chances are your health's probably better. You never know how that's going to change, and you may not be able to get the cover when you need it.
Yeah, right. So you haven't had an existing condition or something already. So yeah, that's right. No exclusions, even better.
Yeah. But I guess the key trigger points are debt levels. So if you're taking out a mortgage or you've got loans on investment properties that you want to have protection in place so that if you were to pass away, your family can continue to hold those assets. Thinking about the family's income needs. So if you've got children, how much do the family live off a year? Would there be a lump sum that comes through to support the family? Because often clients will say to me, well, I'll keep working if something happened to my partner, but you can't put a price on the emotional change in your life if you lost someone. And the chances are you probably have less focus on your career and more focus on family and kids. So that's
and even a real example of that too is you might have young kids and you might be thinking private school for them, but if you were to pass away, private school might be off the table all of a sudden because your partner's not making enough to be able to do that. And if that's what you're working hard for and that's what you're trying to do with your life, well, yeah, why not put in a mechanism in place that makes sure that can still continue, even if you don't, unfortunately. You want to make sure that you're setting your family up in the right way.
No, you've nailed it there, Brendan. That's actually one of the questions we always ask is, do you want a provision there for private education? You've got 3 kids, you want to put them through private school. What's the number look like? Let's factor that in. Like adding a top up to the life cover is probably a very small cost to give you that security and assurance that your kids will be able to continue on the same educational path.
Thanks, Gary. And I guess we're talking about, you kind of mentioned this, but I wanted to get into a bit of tax effective structures. Obviously, you sort of mentioned life. You can put that through super and effectively get it at pre-tax dollars. Yeah. And income protection, we know we can do as an individual as opposed to a super fund. So it's a bit weird. Or we want income protection sometimes in your own name to get a tax deduction, but we want life sometimes with a super fund.
Yeah. And you can hold income protection through super as well. It is an option. So sometimes cash flow's really tight, it's better to have some cover than no cover. So you can fund it through super. However, it's a bit more restrictive because you get tangled up in the superannuation rules when you've got a claim. So it's a bit more straightforward if you're able to hold income protection in your own name. But that's there as a backup if you can't.
And if you had the policy in your super fund, say it's one of these ones, or retail or whatever policy, if you've got your insurance there, and particularly income protection, it's typically a pretty general per policy and maybe not suited to your needs. Would that be fair?
Yeah, the definitions are a bit more general, and you've got a few more hurdles in the event of a claim. So you've got to get it through the insurer as well as the trustee board of the super fund. Whereas if you hold an income protection policy personally, the contract's just between you and the insurer. So it's a bit more straightforward in the event of a claim. Probably the other one that is useful around managing the cost, you can actually link policies together, which can make a difference. So rather than holding 4 separate standalone policies, you can link the cover so that if you claim on one, the cover level reduces on one of the other policies, but you've got an option to buy that cover back if you need it. So that can be a way of managing the overall cost of the cover in a tax effective manner. So we always look at trying to package the cover up that way for our clients to help with cost.
And I'm sure as a financial planner too, it's not just insurance you're looking at. You're factoring this in with a lot of things. I guess it's there's a fair bit you guys have to look at when talking to clients.
But what I'd say is insurance is the foundation of your long-term strategy. Like you can have the best investment strategies and personal tax planning and all the other factors of your financial plan, but if you don't have the insurance there in case something goes wrong, well, that's where everything else can fall over. So it's such an important part, and that's why I always say to clients, get it in place early, at a younger age, so that way you're set up for the future.
Yeah, I remember someone gave me a good example once. They said if you owned a $2 million property, commercial property that was returning 6% a year to give you 120 grand a year, would you insure it? And most people say, oh, of course I would. But then you say, oh, have you got personal insurance to cover 120 grand a year you're making? Oh, no, not yet. So it's sort of one of those things. You're possibly your best asset, but people are likely underinsuring it.
Exactly. Yeah.
In saying that, I think probably the reason you and I chatted about having a good chat about insurance on the podcast is last 3 or 4 years, premiums seem to be going upwards.
Yeah.
Why is that? What can we do about it? What's the reason?
Yeah. So I guess probably the key area where premiums have gone out of control in the last few years has been more on the income protection policies. That's where we've seen a big uplift. And I think historically, some of the policies issued by insurers were too generous. There were too many what you'd call bells and whistles attached to those policies, and that have led to claims. So insurance companies had to scale back on how generous they've been on those options. And secondly, just the volume of claims, there's been an uptick there, particularly in the area of mental health claims. So that today they actually make up 1 in 5 claims for income protection is related to mental health conditions. So I don't think
10 years ago that would have been a very low number, wouldn't it? Yeah,
it was lower, and I don't think insurers sort of predicted where it was going to get to. So that's one of the reasons why premiums have sort of gone up. So I guess we work with our clients today on strategies where we can help sort of minimize the cost, but making sure they're getting value for their money with their cover that they've got in place. So things you can consider are if you've got like a so-called premier policy that's got extra benefits, maybe it's downgrading to a more standard policy that gives you some basic cover. As we said before, you can extend the waiting period on income protection. So if you feel like 30 days, you could last to 90 days in the event of a claim, maybe that would help manage the premium cost. Adjusting cover levels. So, having a look at what the level of cover is. Often they get indexed over time. Is the cover level still appropriate, or can I afford to maybe trim it down slightly? Often when you're on claim, that gets indexed over time, but you do pay extra for that benefit. So that might be something that you can do without.
And if
The other
you've got
one,
an existing policy too, it's not as though that's always a set and forget. Sometimes you can tweak it, like the wait periods of things. You can tweak those existing policies without affecting the actual policy. That's right, I believe?
correct. You still keep all the definitions, the basic crux of the policy stays in place. It's just you're adjusting the
Playing around
feature.
the edges.
Yeah. And probably, look, the big one I'm seeing more of is potentially rewriting your cover. So applying for new cover if there's a more appropriate policy out there. Obviously, you've got to be really careful doing that. You've got to be comfortable with the new terms. And always, if you are applying for new cover, you always want to keep the existing cover in place until you know what sort of terms the new insurer is going to offer you, to make sure that
it's in place before you cancel the old one.
Correct. Yeah, you never want to have yourself uninsured. So,
or even have your existing policy, but maybe just have a little top-up one just for the next couple of years, or 10 years, 15 years, whatever, and then drop that one and keep the original or something like that.
Yeah, that's right. So there are plenty of strategies out there to manage costs, but you really need to keep an eye on it and at least have a look at it every couple of years, because if you leave it, 5-6 years, well, then the premiums can really take off before you know it.
Yeah, that's right. Absolutely. And some of the strategies, I think also we talked a bit about when you get into it, younger the better, from a, not getting exclusions, and definitely when you got kids and debt and things like that, and a partner, that's sort of a big crux to get in, or a big reason to get in. But sometimes I guess at the back end, there's reasons to get out as well. You sometimes want to dial that cover out of it.
Absolutely. That's the importance of the reviewing the policies. Like, over time, most people start to build up their personal wealth, their personal investments. The mortgage on the home gets paid down, superannuation's building. So you might be in a completely different financial position to where you were when you took the cover out. So potentially trimming that cover down over time to offset any premium increases, to make sure that you're getting value for money and you're paying for the cover that you actually need.
Particularly if I'm this 35-year-old doctor, fast forward 20 years later, I'm now that 55-year-old doctor, my kids are growing up, I've paid off my mortgage, I've got good savings, I've got money in super, and all of a sudden I'm paying a fair bit in premiums for my income protection because I'm older and the premiums go up. And it could be the case that policy that's going to pay out might actually be a policy that cuts out when I'm 60 anyway. So I'm fighting around and paying 25 grand a year maybe for this really expensive policy that actually will probably end in 2 or 3 years' time anyway. Do I really need to keep paying that if I've got the financial backing to not need to?
That's right. Yeah, that's absolutely correct. And often with our clients, we work on a sort of a scale down process of just trimming cover around the edges each year or over a couple of years to make sure that it's still valid and
so the key is, I guess, make sure you're getting regular reviews, talking to the Gary Deans in the world out there, and making sure your financial planner's on top of it, and reviewing what you have to make sure it's appropriate for you.
Yeah.
That's awesome. Thanks, Gary. Any other points you wanted to add in there? I think we've covered the main bits about what's happening in the industry and when people should be looking at it.
Yeah, look, I just encourage people to really have a look at what cover they've got in place, particularly, as I said, if you're relying on what you've got in an industry super fund or an employee corporate fund, just be really careful about how the cover works, what are the terms, and is it right for me? Because we just see a lot of people get caught out just thinking, oh yeah, I've got some cover there, it should be fine. And it's not till something goes wrong that then you realize, wow, I wish I'd done something about it. So
that's when you look at it all of a sudden, isn't it?
Yeah.
All right, brilliant, Gary. Thanks for joining us. It's a short, sharp podcast as always, so we try and keep it tight. But thanks for joining us. Really appreciate it. I hope everyone out there did as well. More info on Gary, jump on the prosperity.com.au, find you on there, Gary Dean, or one of the financial advisors, or ring your financial advisor or your contact at Prosperity. Have a chat to them, and I'm sure we can help you get talking to the right people. I'll put some of your details up in the notes too, Gary, so people can get hold of you. Thanks very much for coming on.
Anytime, Brendan.
Cheers. Thanks, guys. Thanks for joining us for today's podcast. Hopefully you liked it, and if so, please give us a few stars, like and share. And if you'd like to follow the series, please subscribe and pass any information on to your friends as well if you think they might like it. For more information about who we are, head to prosperity.com.au and follow the links.